Yeah, so I've actually covered this relatively recently, but it's had quite a dramatic price movement with all the tariffs. So we'll get into that a bit. But this is one of those companies which we constantly get questions about, and we have really the past, I don't know, 2-3 years ever since it's really had a change of pace. So it's quite an interesting and topical company to go over and update as well. But if you're not aware, Celestica, symbol CLS, it trades on both the TSX and the New York Stock Exchange, provides electrical manufacturing services broken into two segments financially: Advanced Technology Solutions, or ATS, and Connectivity and Cloud Services, CCS. ATS includes a wide array of products and services for industrial usage to aerospace and defense. CCS is predominantly enterprise-level data communication information processing infrastructure, including routers, switches, data center interconnects, edge solutions, servers, and storage-related products. And as well within that, they do have the hardware platform solutions, HPS, which is to do with high-speed data interconnects for AI and machine learning, and we'll get into that as well. The shares are trading at roughly $87 US. I'll be doing everything in US dollars because that's what they report in, and that's a $10 billion market cap. The shares of the stock had still a relatively strong year, but have come off the all-time high set earlier in the year. And since last coverage we had on the stock, it has come down as well. We covered it actually right around the peak. Last time I mentioned the stock traded at a significant premium relative to its historic self as well as its peers. With the price dropping, valuations will have come down as well, but we'll get into that as well in a minute. But overall, stock still very high compared to it was a year ago, but it has come off the peak, and that's similar to most other tech companies. Trump's tariff liberation day really spooked the tech industry, and they've all pretty much followed the same trend of falling quite a bit and then rebounding over the past week and a half or so. A quick look at the last quarter, Q1 25. Total revenue was up 20% to $2.65 billion, above the guided range, with CCS segment up 28% to $1.84 billion, driven by high growth in the hardware platform solutions, HPS subsegment within that, and that grew 99% to $1.03 billion. So that's your growth driver of the entire business. It's HPS. And it's that focus on AI and machine learning networking products. So it has really just benefited from that trend overall. And that really needs to be our bold thesis for Celestica as a whole, is the AI trend continuing. Because without that, they are not seeing the growth that can even remotely support a valuation at which they're currently at. The ATS segment grew at 5% year over year to $807 million. The revenue split at this time is 70-30 CCS and ATS, with HPS accounting for 39% of the total revenue. So it's actually over half the CCS now. And that CCS segment, because it includes the HPS, has grown it to more and more significant share of the total revenue over the past few years. Non-GAAP gross margin came in at 10.3%. The company is a contract manufacturer, and low margins are just normal for the industry. That's what you expect. So across the board, expect low margins for anything in the space. Adjusted operating margin came in at 7.1%, an improvement from 5.9% in the previous year, and that's above the guided range of 6.8%. GAAP EPS came in at 74 cents, and adjusted EPS came in at $1.20. Both of those are above the guided range for the quarter. So overall, good quarter, beating the management's guidance. That seems to be their trend. They seem to do a bit of sandbagging. Guidance normally underdoes the actual performance, or the actual performance overdoes the guidance, however you want to look at it. So free cash flow, moving to that for a minute, it grew 38% to $94 million from 68%, despite being negatively impacted by increased working capital of $46 million compared to the prior year's negative impact of $13.5 million. So you're seeing that as you build a business, you are going to need to take on more working capital. That's not surprising. So when you are looking at free cash flow metrics, especially, or even operating cash flow metrics, it's good to pay attention to that working capital level, because right here you see it does jump quite a bit compared to the prior year. But that is always something you need to keep an eye on, because it does impact the company. So good growth overall, just despite the increased working capital still. Shifting to the balance sheet, the company has gross debt of $887 million and net debt of $584 million, resulting in a gross debt to EBITDA of 1.1 times and net debt to EBITDA of 0.7 times. The company is leveraged, but that leverage is not really a concern at this time. Their growth is supporting that level of leverage. And looking forward now, the company actually did update their guidance, shifting up annual guidance just a touch, pretty much, and as well as releasing their Q2 guidance. For Q2, they're guiding revenue of $2.575 billion to $2.725 billion. So that's $150 million range. Adjusted operating margin, I should say, of 7.2%, and adjusted EPS of $1.17 to $1.27. So overall, good guidance. It's looking at sequential growth. For the year, the company raised the revenue outlook to $10.85 billion from $10.7 billion, adjusted operating margin to 7.2 from 6.9, and adjusted EPS to $5 from $4.75, while keeping the free cash flow the same at $350 million. Guidance increase is good, especially given that weak tech environment, which I mentioned before, from the U.S. trade war. The company's guidance assumes no material impact from tariffs or trade restrictions, which as we have seen, can change quite quick. So that could change, but that's what they're basing their estimates on. And any tariffs, so at this time, are just passed through to customers. So less of a direct impact to Celestica. But what I would be concerned about is the indirect impact if we do see a massive drop in demand, as well as just within the space, and as well as just a general macroeconomic condition. It would likely impair the company's growth. As if that does occur, you'd likely see a bit of a pullback from the hyperscalers. But at this time, we haven't seen that. So far, they've all been reaffirming their data center spend for the year, even though there has been quite a bit of speculation and then rumors, and they go, "Oh no, our spend is the same." I think you've seen that from Microsoft and Amazon, both having that scenario play out so far. I could be missing some as well. But moving to valuations, based on management's guidance, the company trades at a forward adjusted P of 17.4 times, a price to free cash flow of 28.6 times. Still high in valuation compared to historic levels, but of course the company has seen significantly higher growth over the past few years, now with AI booming compared to what they used to be seeing, which was really marginal growth. So overall, the company is much more appealing than when I last covered it, just because that valuation has come down quite a bit. I didn't have it up in the last time, but I think the forward adjusted P last time I covered it was 27.4 times. It was a full 10x multiple less, just to give you an idea. So it's much better valuation. The growth is still powered by HPS, which is not a surprise, and that really isn't expected to change. Still a good balance sheet. There is a bit higher macro risk with tariffs and just a general slowdown, but the price drop is, I would say, offset that fairly. Unless we do see a significant pullback in AI spend, which of course that is really the risk with the company. The valuation is much more reasonable. Was trading at premium before, so I'd really more put it at a fair value right now instead of a premium valuation. If you do see continued strong AI growth for the next, let's say, year to 2 years, you'll likely see the stock perform well. But then on the flip side, if you end up seeing the hyperscalers start to pull back on their capital expenditure for AI data centers in general, you'll likely see downside. That's really your external trade-off at this point, and that's why I would rate it really around fair value. The valuation is an extreme or a screaming fire sale at this time. So for now, we will continue to monitor the stock. And for disclosure, we do not have any position in the company or any relationship with it.
Yeah, I think fair value is a good call. I think that's about where it is right now. It's balanced between, I mean, if you knew that that the trend in its growth market was going to last for 5-10 years, then you'd be buying Celestica right now. That's where you just don't know. There probably is a 10-year plus growth trend. Is it going to be like this though? I'm not sure. Maybe it's not going to be like that. So, there may be a more opportune time to buy, but it can be fluctuative in terms of its earnings. It certainly performed well over the past year, though. However, any further thoughts?
I would say that's really indicative of the industry as a whole too. It's not just picking on Celestica, and I think that's what a lot of people aren't really accounting for. Those Super Bowls of companies like this it's a cyclical environment. You're going to have spending pullback at some point, whether it's a year from now or 5 years from now. That's the big question. And right now it does seem strong, but it can change quite quick, and you will see valuations plummet in that case.
And that's people, where you need to be aware that valuations cannot be premium.
Recognize the difference, like when they're looking at a technology company. There's a big difference between a SaaS software company that's generating sticky recurring revenues. They don't have to go out and re-sign their client. They just have to provide a service so their client doesn't cancel on them, right? Where there's more friction when you're doing these big jobs and then you have to renew them with other big jobs. And so you're generally going to get a lower valuation. Then plus, again, there's the lower margin. You would expect a lower valuation from that. But, sometimes when you associate a company with a very hyped field like AI, then that moves it in the other direction.
Yeah.
One thing I will say on AI that I have heard a little bit of, recently, just I would say the last couple of months, is a lot of companies finding that, they went through a period where they've spent a lot on AI and everybody's rushing to spend on AI. But now in many cases, companies are kind of questioning, like, well, where was the actual ROI, return on investment, that we got from that? And they're really kind of looking at that more and taking perhaps in some cases a slower pace to try and determine whether or not it is actually worth it, or if they're just, really interesting tools that they're adding, but it's not really making the businesses better. So in some cases, it's making the businesses phenomenally better. But again, you can't just spend and invest blindly. It needs to be deliberately and based on research.
Yeah, I think there was a period too, fear of missing out. You gotta,
Mm-hmm.
your neighbor company is doing that. Oh God, I gotta be in. And there's certainly some amazing use cases, but there's nothing like a little time of uncertainty to have people start looking at, wait a minute, is there an actual ROE on this? And that's what we're going through now. And then people start to say, I don't, spending pulls back. And I think that more than anything is what's going to come out of this tariff period, the uncertainty and the spending pullback. It's hard to spend when things are uncertain. So you're going to see a pullback.
And
particularly in some areas.
any technology, any theme, there's going to be fluctuation in the spending and the interest. Like look at the internet boom and bust, the .com bubble, right? Yeah. Obviously, the internet was a very real technology. All the stories that were being spoken about at the time were true, but that didn't justify infinite valuations for companies that had .com in their name. And we saw how that played out, but then the industry rebounded over time, and we have a lot of highly profitable companies that have come out of it.
Yeah. Brennan loved pets.com. He was all over it.
Well, it was a new normal. So, I just, this new normal with .com behind all their names, normal.
Brennan was like 6.
It was literally just a website with pictures of pets, and it got $100 billion valuation.
I think $2 billion. It's crazy.
Yeah, I can't remember the exact story from the Intelligent Investor, but like this would have been one of the newer versions of the Intelligent Investor with I think Warren Buffett wrote kind of like the preface to it. But he ended up using, I can't remember the exact name, but it was some stock where, exactly, they put .com behind it, and you were just seeing like insane moves. Again, I was 6 at that time, or 5, so unfortunately, I wasn't investing yet.
Yeah, Brennan, you were.
I think Pat's got to like 400 million or something like that, but it honestly, there was companies out there that just got to crazy, silly valuations, and literally just had a website.
New normal.
At least, there is. Well, not all the AI companies. I was going to say there's something behind, but some of the core companies there is for sure. Mm-hmm. And at the time there was, even in the internet boom, the core companies, the Amazons, there was something there as opposed to, pets.com. There's always these ancillary pieces.
Oh, you don't like pets?
It's my hatred of pets. No, I have several of them. So